Good morning. This is Andy Cates from the Global Economics Department at UBS. The economic and market environment has continued to generate a lot more bad news than good. The good news is that tentative signs continue to emerge to suggest that the plumbing of the interbank lending markets is being mended. That at least is the message from the recent drop in LIBOR rates. The bad news is that LIBOR spreads are still a long, long way from what might be regarded as normal, and other gauges of the cost of finance are still somewhat concerning. Meanwhile, a wave of fairly dreadful global economic data, along with several underperforming earnings items from the corporate world, has been providing a stark reminder, if anyone needed one, that the economic arena is clouded with darkness. Overnight, we've seen another drop in the weekly ABC estimate of U.S. consumer confidence, so that it now stands just 1 point off its all-time low. Japan's all-industry tertiary index tumbled by 1.8% in August, below expectations. These data points follow another steep drop in the weekly estimates of U.S. store sales from yesterday, and they follow a fairly dreadful UK CBI industrial trend survey, again from yesterday. One of the items within the detail of that CBI survey that caught our eye was the massive jump in the number of respondents that are saying that they're cutting back on investment because external finance is increasingly difficult to come by. The balance of respondents claiming difficulties rose to plus 16, dwarfing anything that has been seen in this survey over the past 30 years by a long, long way. A strong indication of the issues that are now plaguing the UK economy. On that score, note that the UK's National Institute and Bank of England Governor Mervyn King have waded into the waves of pessimism with public statements suggesting that the UK economy is probably entering a recession, as if anyone needed the tip. Markets, meanwhile, in Asia have been responding to all of this, with equities mostly a lot weaker overnight. Commodity prices are also mostly weaker, and particularly oil prices, and the value of the euro is also a lot weaker, thanks perhaps to the somewhat circular relationship that it enjoys with commodities, but also perhaps because of a safe haven bid for other US assets. The day ahead, for the record, is a fairly quiet one, with the latest Bank of England monetary minutes the only item of any note on the global calendar. We expect these to reveal a 9-0 vote for the 50 basis points of easing that was enacted, though it's possible that Blanchflower voted for a little more. Finally, in this environment of balance sheet deleveraging in the private sector, the onus of responsibility is clearly falling on governments to find some offsets in the form of fiscal stimulus. The spirit of John Maynard Keynes, in other words, is very much alive and kicking. One issue, though, to which we take exception is the idea that real long-term rates need to keep climbing in response to higher actual and expected levels of government issuance. This isn't, though, what usually happens when governments step in with activist fiscal policy measures. It isn't what usually happens when governments are simply plugging the gap left by the absence of corporate and mortgage issuance. And it isn't what usually happens when economies move into a recessionary phase and significant disinflationary pressures are unveiled as capacity usage rates drop. The liquidity-related and fiscal policy-related measures that are being enacted are, of course, inflationary policies. That doesn't mean that they'll lead to inflation, because they're designed to deliberately counter the intense deflationary pressures that are being unleashed by the financial turmoil and previous balance sheet excesses. That's all for today. Thanks very much.